Okay, this session is about unlocking capital across the investment chain. We've got Simon's going to join us on the TV, isn't he, in a minute? But I think what I was going to do is just set a bit of context of investment at Eden, actually, and the capital investment at Eden. Hopefully there is four pictures on that TV screen over there. And actually, some of this relates to the conversation we were hearing before the lunch break about public-private sector partnerships. So the pictures you can see there, obviously, one is Eden Project Cornwall, £140 million capital investment. Next to Eden Project Cornwall is Eden Project Morecambe, which is in development. It's a £100 million capital project. Currently, we're at £98 million. So look down the back of the sofas, everyone. We just need 2 million to get this over the line. And then we've got Eden Project Dundee, which is about 120 million capital. And then Geothermal, Eden Geothermal, which was 23 million. So all of those projects, I've been at Eden for 20 years, by the way, and I kind of look after our funding relationships with government, with lottery, with charitable foundations. So I've seen all of these come through. And the consistent theme, or the common theme with all of them is that they're a kind of mixed model. I don't know whether you call it blended finance, but basically the way that we have to operate our capital investment is that the sites we choose are inevitably tricky sites. So we deliberately choose sites that are derelict, sterile, difficult. Financially, they don't stack up on a commercial level. So at the very base of it, you need a government grant, an anchor grant, in order to help you support the capital investment. Here at Eden, it was 56 million lottery money. In Morecambe, it's 50 million levelling up money from the government. And then we add a commercial loan onto that. So 20 million debt here at Eden to start when we opened. The Lancaster Pension Fund are currently putting in 35 million to Morecambe. And then we balance the rest with kind of philanthropic grants, if you like. So we have, I guess, 3 different stakeholders every time we go for a capital raise, each of them asking different things and each of them having different requirements of us. You know, our government clearly want us to deliver outcomes that support regeneration and transformation in the UK. We want to create jobs. We want to drive supply chain. We want to support education outcomes. You might have a philanthropic charitable foundation, let's say the Garfield Weston Foundation or Wolfson Foundation, who are more interested in the scientific activities that we're doing in this place. And then finally, you would have your kind of commercial debt or your loan provider that would be very much looking at the bottom line and to see how much you can drive EBITDA. And I think what's interesting for us is that if you take Morecambe as an example, really difficult positioning in terms of when those particular funders come on stream and how comfortable they are with the development at the time you need it. Because we were lucky in that the government took the first step with us on Morecambe and they kind of announced the 50 million and then put down the challenge to us that we need to match it for pound. And for them, they came in at a stage where we might be just delivered a feasibility study. We've got a business plan that is based on how this place works with a bit of kind of economic impact assessment work. And we hadn't got to planning. And so therefore the investor, Lancaster Pension Fund, are saying, we're only going to invest in this project when you're at REBA stage 4, right? So this kind of process where you've got planning permission, you're very clear about what your capital cost is and how you're going to start to deliver that. So there's always an ongoing conversation and a tension between what our funders require from us and at what time they require it and how that feeds into the other stakeholders. So Tim always describes this as the country dance, or somebody else describes it, who's going to jump in the swimming pool first, because the first person to jump in would inevitably mean that everybody else comes in. So I think that's a kind of interesting, I guess, context around funding and how we operate, and how do you bring private and public sector money and charitable foundation money together in order to deliver the transformation that we see outside and hopefully within Morecambe and within nature going forward. Thank you, Dan. Over to you.
Thanks, Dan. Thank you for that context. Just by the way, by way of context and introduction, my name is Dan Wells, and another Dan, and the other Dan here. I'm a partner at Foresight. I'm also co-manager of our energy infrastructure fund called Foresight Energy Infrastructure Partners, or FEAP. Dan's just given us some context there on some of the challenges on raising and attracting capital in a kind of blended finance perspective, including philanthropic capital. We're going to talk now more from the kind of pure institutional capital perspective, but still some of those points are very valid, and I'm sure we'll pick up on things like timing of capital being allocated to investments as they de-risk, etc. We've got a fantastic panel to discuss this. Two here in the room, we have Richard Thompson, another partner at Foresight, the other co-manager on FEEP. So Richard and I spend, at the minute, more time with each other than probably our families, managing and the fund and raising capital. But don't worry, I won't go easy on you, Richard. I'm still going to ask difficult questions. So Richard's bringing the kind of fund manager perspective. Peter Smith, who is head of investment.
I'm head of Smith as well.
That's head of Smith now. Okay, there we go. Congratulations on that promotion. Peter is the head of investments at TPT. So Peter is actually wearing two hats, the fund manager perspective, but also the capital owner perspective as well. And then beaming in from France, we have Simon Ludlam, who is the CEO of Mares Connect, a development stage interconnector project, of which Foresight is an investor, just a kind of full disclosure. We're going to be talking about challenges in unlocking capital into sustainable infrastructure and nature investments. I want to quickly pick up actually the discussion we had at the end of the last panel there. So Kate from Astrid, and Astrid being a placing agent we work with on our fundraisers, is representing the voice of the kind of investor community here. And I thought that discussion essentially between like the investor community saying, hey, how do we get capital into nature? This is a risky asset class. We need for more visibility, more de-risking, etc., which is exactly what all the money is saying. And then the panel kind of working to answer the question and making the point, well, you know, part of the point is, but what about the risk of not investing in nature? Have a look at the news headlines after this session and see what's happening with Hurricane Milton right now. It is horrific, and it's a key, you know, that's a real-time example of the risks of ignoring nature. And that bridge we have to build between essentially articulating what investments in nature look like and how it maps into the institutional investor kind of world is critical. And I would be really interested, and I'm going to pick out some people here, in terms of like what the investor community thinks about this. Peter will think about it. Peter will make points. We've got Jem Bishop from Coal Pension Trustees. How do you think about this? Sahil from London Civ. These are major institutional investors. How are you thinking about the barriers holding you back from investing in nature? But we're going to move from nature back into infrastructure. Richard, I know you'll feel more comfortable about us being back in the world of infra, not the world of nature. And we're going to talk about barriers to unlocking capital here. And I'm going to start with Simon. Simon, from your perspective, as CEO of Mares Connect, what do you see as the challenges of raising capital for large-scale projects, such as the one that you're working on?
Yeah, well, hello to everybody. Wish I could be there with you. When it comes to interconnectors, they're all about, you know, a billion of hops. So there's a lot. It's a big art. There's quite a large amount of DevEx to go into being in a position to actually construct. And so right at the beginning, you're asking somebody to take quite a big risk on a very large project with quite a bit of DevEx, two regulators, two governments. So I think, you know, the overall sort of structure of the deal can appear at first sight challenging. So I think what we try to do is, first of all, break it up into chunks and try and address, start with to the potential investors, what's the overall narrative? Why does it make sense to do this? And then address really head on what are the biggest risks that anybody investing in would face right at the beginning, particularly the DevEx phase, and how we would address those, and over what time frame would we expect to resolve them. If we can't get through that very first point, we'll never get into the DevEx stage and we'll never get a chance to do construction. I think probably the other bit is that we recognize equally that the returns around development are often, you know, multiples of 5 to 10 times, whereas when we get the actual asset that's built, which is maybe regulated, the returns will be lower. So it's also thinking carefully through who would be the right piece of capital to come into the DevEx stage and then potentially construction and then ultimately the operations. So maybe that just gives a little bit of a flavor of how we look at it. Yeah.
Absolutely, Simon. I think that does chime with what Dan was just talking about in terms of allocating the right capital at the right time to projects. I'm going to ask a question to Richard now, just in terms of how you think about infrastructure investing. We are going to bring up a Slido poll as well. So I'm going to ask the question to Richard first, and then I think we'll bring up the poll, and we'll get we'll get audience input. So Richard, from the fund manager perspective, what are you looking for in infrastructure investments, and what are you looking for in terms of a high quality investment you would look to make?
Sure. So I guess one of the advantages of, say, infrastructure as investment class, maybe compared to natural capital, is that it's been part of alternatives portfolios for maybe 40 years. So it's relatively well understood, offers stable cash flows because of its long-term nature, often with inflation protection, which is quite important to the end investors in the portfolio, pension funds, insurance companies who may have inflation-linked liabilities. It's a tangible physical asset. It'll have high barriers to entry. So once you're investing, you're getting that steady return. From our perspective, when we are investing large sums of capital into these assets, we are looking for very stable regulation. And that's sort of regulation, at the point that you're, say, investing to build the asset, you need that regulation locked in, providing contracted revenues over the long term. But then importantly, if we're going to make a development stage investment like the interconnector that Simon's mentioning, we need to have clear signalling and good visibility of what that policy landscape looks like over the next 5 to 10 years. So that visibility is very important. Taking almost sort of regulation of these assets slightly out of the political cycle can be helpful as well. Companies will invest tens, hundreds of millions of pounds into some of these large assets at the development stage. But if you have a change of government and a change of policy, that creates uncertainty and then makes capital potentially more expensive. So stability of regulation, very, very important. And I think we heard from Nicholas earlier that storage, interconnection, and grid are absolutely key and at the centre of increasing Europe's competitiveness. Certainly in the grid arena, it's quite difficult in many European countries to get private capital into those assets at the moment because those assets tend to be run by either regulated monopolies or state-owned entities. And on the long-duration storage side, in many instances, there's an element of market failure. So you need that ability to secure contracted revenue in order to get the capital into the assets.
Yep, absolutely. Thank you, Richard. So that gives you a feeling for some of the kind of shape of the risks that fund managers look to mitigate in infrastructure investments. So we put up the Slido poll in the meantime, and the question we've asked to you is what is the key factor holding back investments into large-scale infrastructure and nature-based projects? Now, Peter and Richard can't see the result of this poll at the minute, so I will explain it to you. But essentially, the options are lack of risk appetite, lack of available capital, lack of clear regulation, and lack of high-quality projects. Now, what we as an audience, as a community, are saying is that it's definitely not the lack of high-quality projects, so there are lots of projects going around. There is some feeling that there is a lack of risk appetite and a lack of available capital, but the single biggest reason is lack of clear regulation. Now, I would speculate that from the perspective of fund managers, and pension funds, insurance funds, that's definitely what we would say is that we want more clear regulation, we want more contracted revenues. Do hear people from government and regulators also saying, yes, but the private sector has to take some risk. You have to take some risk. And there has to be an evolution in how we think about risks. So we're saying clear regulation is kind of the main thing. I'm going to turn to Peter now. So Peter, from your perspective, from the perspective of pension funds, how do you look at this world, and what are the kind of key challenges that you see in terms of mobilising capital?
So those results are good because I wrote down literally 3 bullets to cover, and they were incentives, objectives, and regulation. So I think we've got 2 out of the 3. So just quickly for who I am, because you may not know who TPT is, no one usually does. So we're a fiduciary manager, so we manage pension scheme assets in the UK, but we're also actually owned by a pension scheme. So the traits we've talked around about what asset owners are looking for in terms of long-term assets that stretch, multi-decade, we share that vision of asset owner view of the world, but we're also looking to try and consolidate pension schemes to create scale to invest in these projects. So ultimately, the UK is, for those that don't know, the corporate DB space has about 5,000 DB schemes. That's excluding local government pension schemes, and that's excluding defined contributions. So I'll split the world into 3, and apologies if I use sort of pension jargon and cover it later for those that don't understand it, because it's understandable. But I think the first pool is largely LGPS. So, and I'll probably use incentives for LGPS, objectives for DB, and regulation for DC. So if I look at the LGPS, they're probably actually the ones that at the moment are doing the most in terms of natural capital and nature investments. So LGPS is local government pension schemes. There are 7 pools in the UK, actually England and Wales. They're basically pooled assets of local governments. The slight issue there is actually they don't necessarily have the right incentives, I would argue, that they're not always economic buyers. So some of the things we talked about around return objectives, the level of risk they're willing to take. Actually, a lot of the LGPS schemes, what their primary objective is, how can they support their local community? And also, if they're looking at local or central government regulation, it's putting themselves forward as a provider for improving the community, which actually means they do a lot of place-based investing. So they're not necessarily looking at the UK more generally. It's how can I support where I am? So it's probably the positive in the sense they're doing something, but that then limits their capital as to probably where they're looking to invest. And also, from our perspective, that we are a pure economic buyer, it actually pushes up the price of some assets to the extent the expected return on certain assets is probably not attractive for us anymore because there's a mismatch between supply and demand. So that's probably local government. The second one is defined benefit pension schemes, where I spend most of my time. This one is really one as objective. So, I think the questions earlier around why do pension schemes not allocate more to things that are higher risk? The short answer is they no longer need to. So if you think what happened back in 2022 in the gilt crisis, gilt yields have gone from, +1 to +5. Pension schemes are much better funded than they used to be. Deficits are much smaller. And their objectives have changed. So you think of this pension scheme as 100 years worth of liabilities. Fortunately, they don't allocate capital, close their eyes, go away for 100 years and come back. What they do is they monitor the objectives along the way, funding levels change, their risk and return objectives change. And actually what you've seen from pension schemes is saying, well, we don't want gilts plus, or, use real English. We don't want 8% return anymore, we want 2%. And that is because actually in 5 years, I want to move my liabilities to a buyout provider, to L&G, to Prudential, whoever. And therefore, A, I need a lower level of return. So I don't need to invest in biodiversity net gain credits because it's quite uncertain. I'd rather invest in a UK investment grade bond. And actually, I need liquidity because in 5 years, when I go to Legal & General and say, here's my portfolio, they'll look at all the illiquid stuff and say, we don't want that. Here's a big write-down. Give us your liquid stuff. So the way you have to think about institutional capital is it's not a 100-year investment. It's a series of 5-year investments. And I think that touches some of the points earlier that when you're locking capital up for 15 years, that presents real challenges around how do you rebalance your portfolio, how do you pay member benefits, boring topic I can talk to you about later, LDI. How do you manage your hedging strategies and provide collateral to counterparties in the event of extreme scenarios, which means you have to limit the amount of private capital you can invest in. And then skipping neatly onto the third one, which is DC, I would sort of put that in the regulation category. So apologies if anyone in the UK government here. The way I look at the regulation around DC is sort of it was screwed up from inception, that DB doesn't have any explicit charge cap. So you can put it together a good diversified portfolio and it might cost you 1.5% per annum to run, but your net return might be 10%. DC, when it was first introduced in the UK, it had something, the concept of a charge cap, which basically said 75 bips or less. Well, actually, what providers took that to mean was how far under 75 bips can we get? What that's done is it's driven capital to liquid passive investment with the likes of Legal & General, BlackRock and Mundi. It's not their fault, it's just where the capital's ended up. There is no appetite to start adding illiquid expensive assets into their portfolio at the current time. And I say that at the current time. I think that's changing. You're starting to see some providers start to think about how they can introduce private credit, natural capital, because there are people out there who are interested, but I think that is slow burn. And also the regulation means that DC pots are, again, quite fragmented. They need to come together, be regulated to drive quality to the large providers, to give them the scale to allocate money to private capital at a lower cost. So there's barriers to all of them, but they're different. And I've used UK very much as an example, but I think you can probably use that globally. Understand the buyers' incentives and what are the barriers that they have, and they will all be different.
Mm-hmm. I think that's such an important context, because whichever market you're in, if you're in the UK pension market, and you can see these kind of, it's the details of the financial plumbing system in that system that will be completely unknown to everyone outside it, but have these huge consequences for how capital is allocated towards all these kind of themes. I'm going to bring Simon back into the discussion. Simon, I think it would be really useful to talk a little bit about specifically what you're doing with Mares Connect, so the project itself, how it helps unlock European decarbonisation. And you talked a little bit about the barriers that you see in terms of getting capital to work. What are the things you've been doing in terms of your own approach to help take away those barriers and to help mitigate risk?
So there are a number of things we can do, and particularly at the early stage, we can split it really into two parts. One, we can go out and just get money. So if the project, for example, falls into what we call TYNDP, the 10-year Network Development Plan for Europe, in terms of a piece of transmission infrastructure, we can request CEF funding. And that's kind of matched funding. So it's funding that the European Union will provide at the earliest stage of the project. And, if you have, for example, a seabed survey that's going to cost 10 million, they'll fund side of it, providing somebody else will provide 5. So those type of pockets of capital are extremely welcome. And they're there right at the very earliest stage of the project, and when it's most risky. I think another way, there are other things as well. And today, we began knocking the door at UK infrastructure and GB Energy. I must admit, they are particularly risk-averse institutions at the moment, although GB Energy yet to be seen. But there are other institutions out there that, in theory, whose remit is to support these type of projects to decarbonise Western Europe. I think the other thing that we can also do is, ultimately, if we can't get the money directly from these institutions, then we're turning obviously to private capital to do so. And in order to get private capital to do that, we need to give them confidence that if they put the money in, there's a high probability that the project will come to fruition. And there we spend a lot of time with regulators, with governments, to try and push policy to show the investor that this project is needed, is wanted, and please wanted. A lot of political effort goes into that. And so, for example, on Mares Connect, I don't know whether Rich would agree with me, but when Foresight first looked at this, it looked worried. It's just an idea, and Simon and the team have done it before, but can they do it again? But we can go to the government and go, look, you need an interconnected policy, not just for us, but you need to show this to the world that you want more interconnection, and state how much you want, and state the building blocks on which it will be built, not only just sort of from a physical perspective, but also from a regulatory perspective. Gives clarity to investors that it's needed, and there will be a revenue one. And in the case of the Irish government, we asked them to go one step further, name the project. Tell them it's going to be Mares Connect. And we were fortunate there, and they actually put in their policy that Mares Connect will be the next project. And with that, we can then take that bit of paper to Foresight and to others and say, look, it's not just an idea, it's part of policy, it's actually named. And we feel that in that respect, it's de-risked. So now the issue is not whether the project will happen, it's how we execute it. So we tend to work an awful lot of time on the politics of it. I got a joke, I spent one day trying to build a thing and the other day spending time in Westminster and Dublin convincing politicians that it's the right thing to do.
Thanks, Simon. And then just to give some further context, I'm going to ask another question to Richard, which is around looking at then the importance of contracts, contracted revenues, because when we talk about government regulation, often as investors, what we want is long-term contracts and how important that is. Now, if we take the example of what Simon is doing at Mares Connect, which essentially is developing an interconnector cable, which will one day connect Ireland with the UK, and therefore the rest of Europe, that is a massively important component of the future European decarbonisation strategy. Ireland has the largest offshore wind capacity in Europe. It will build that out off the west coast of Ireland. It's going to be really important to future decarbonisation. If we don't have interconnection, we won't be able to economically decarbonise. So these kind of projects are essential to net zero plans. But it's not like investing in a wind farm, which might have a feed-in tariff. When we look at things like interconnectors, it might be structures like what are called cap and floor contracts. So investors have to look at a greater range of contracts to make these assets work. Richard, we often get asked how contracted are our assets. What do you think about the kind of importance of contracted revenues to de-risking projects?
I mean, I think the main point would really be that not all contracted revenue is equal, I think, is the point. And it's about having a revenue model that's appropriate, whether that be regulated or private sector contracted. So an example of highly contracted assets we have seen have been onshore wind farms across Europe where there hasn't been regulated revenue, but there has been revenue through power purchase contracts. Now, those PPAs are all very well and provide no bankable off-takers, provide that contractual certainty. But if they are layered with debt, because of the fairly short tenor of those contracts, typically up to 10 years, the majority of that contracted revenue will be consumed by the debt. So we've actually seen on those types of assets actually better risk-adjusted returns on uncontracted assets. I think that point about having the right form of regulation is quite important. So the UK has been somewhat of a leader, I would say, in regulating particularly grid assets compared to other markets in the world. So there is a regime for contracting offshore transmission links. So offshore transmission links can't be owned by wind farm owners because of EU unbundling rules, competition rules. And so you have to have an independent owner of those. And they, because those assets just sit there and their job is to just transmit the power, that can be an availability-based revenue stream. And that is the way to really minimize the cost of capital. It's inflation-linked, it's gold-plated revenue stream, and you can get kind of long-term, low cost of capital investors into those assets. That type of revenue model isn't good for interconnectors, because with an interconnector, you've got to transmit power in the right direction to kind of balance the grids in two markets and make best use of renewable resource. And so we have the cap and floor structure in the UK for that, where you still have a market-based incentive to operate the asset in the right way, but you have this floor that provides that downside protection on 100% of the capital in the assets. That's that model is very good for interconnectors, but wouldn't quite work for long duration storage, for example. And what the UK government is looking at is a cap and floor structure, but potentially with a soft cap, which means if the asset performs very well, or the market is having is demonstrating kind of high volatility, the asset owner doesn't just stop operating when they hit that cap. There's still an incentive beyond the cap through risk sharing or reward sharing to ensure that the asset is continued to be dispatched in the way that benefits the system most. So the UK, in many places, I would say, has got it right, but we're not seeing that same kind of regulatory design and therefore unlocking of private capital for grid and long duration storage assets in continental Europe.
And part of the challenge is that it just takes so long for these regulatory pathways to go through. It does feel like, as you say, the UK has quietly been getting on with these kind of things for years, but the years are ticking away to 2030 quite quickly, and it's not happening quickly enough in terms of these pathways. Feel free to ask questions. So if you want to ask a question, just put your hand up and we'll bring a mic over. I'm going to do a final round of questions to the guys, which is now looking to what would you think of in terms of a wish list? If you want to, thinking about achieving your objectives as a capital owner, as a fund manager, as a developer of projects, if you had a magic wand, what would you do to make the landscape more kind of easier? Simon, I'm going to ask you a question on this. We had Simon. I'm going to plug the Frontier podcast now. Actually, to go along with the Frontier Forum, we have a Frontier podcast that Chris Holmes and I host with a very loyal fan base. I would say, Chris. Obviously, we had Simon on the show recently, and Simon articulated this amazing vision of a future interconnected globe where you have power, in particular, kind of flowing in a east-west direction to arbitrage the sunshine. So essentially you have the lunchtime sunshine in Europe powering people's breakfast in New York. So Simon, what would be your wish list to help us get towards that kind of future?
Well, I think moving away from finance, but coming back to it in a minute, I think the first thing any developer will tell you is that planning and permitting is the real scourge at the moment. So I think all developers are knocking on the door of all governments and saying, surely we can get it done, get this all done quicker than spending 3 or 4 years planning where some cable goes in the middle of the sea. Now, obviously, we need to do that properly, but I think that's an enormous issue and ultimately strangles a lot of projects, and marginal projects die over that. But in terms of these bigger interconnected mesh grids, I think when you look at it, it just makes sense. We must join up all of these grids together, and no man is an island. We must work together. We all breathe the same CO2. So I think the important thing is to work together. Brexit is hampering that a little bit at the moment, but I'm sure we'll get over it. But I think we need to even be more ambitious than that. And so what we're looking at is, are any of these longer intercontinental cables, do they make sense? So we've seen a couple that have got quite a lot of press. There's one with some cables from Darwin to Singapore that would take solar in North Australia and to one of the large demand centers in Asia, is the island of Singapore. X-Links would take wind and solar from Morocco up to GB and represent up to 7% of the total demand. These are very, very ambitious projects. And another one that we're looking at quite closely is, could we link North Europe via the North Sea to the east coast of the United States or Canada? And as you said, that would lead to, whilst there's no wind correlation anymore, there's negative wind correlation between the east coast of America, North America, and the North Sea. I think as we look forward, we see as probably a wish list is that solar will become increasingly a dominant provider of electricity. And obviously that's very linked to the passage of the sun. And therefore, any place that is separated by 5 or 6 hours means that when the sun is at its zenith here and it is at midday, they're getting up for breakfast in the US. So I think we're looking for governments to perhaps make it mandatory on new build houses that we install solar on every house in Europe and make solar a much more important piece of our generation going forward. So we look. We're looking at that. Interestingly, I think in this current environment where the world is a little less certain than perhaps it was 10 years ago, we're seeing a lot of interest from governments to join up allies. So instead of looking to the east for our resources for energy, people are increasingly looking to the west and thinking, how can we link up with friends that we can trust? Where can we link up with people where we have some sort of leverage rather than just literal or no real relationship, so that if something goes wrong, there's no leverage. I think the UK and Europe has just done extremely well in moments of great threat, at least from the east. The interconnectors, the energy systems work, they respond to market pricing, and we look after one another. So I think another sort of thing on my wish list is greater discussion between our allies, that to see a way of backing us up. Just maybe to add to that, the future probably is not point-to-point interconnectors. It's probably more likely to be what we call hybrid assets, where we have an interconnector that in the middle of the sea branches out and connects to look into more capital going forward. So you'll need to have an offshore HVDC converter station. That's $1 billion. Extra cable, another $1 billion. So these projects become a huge cost, but they do lead to much less cabling on the ground, much less landfalls, interruptions to consumers, and ultimately a much better use of the resources we have, making sure that when we make power, it goes to people who need it rather than either being curtailed or maybe bifurcating through an expensive hydrogen system. But to do that, we're going to have another evolution, I think, of regulation to find a way to bring private capital in, because the TSOs can't afford to do this by themselves. We must bring private capital in. So we're going to have another evolution of regulation that will stimulate private capital to come in and pay these very high sums required to get this mesh grid across Northwest Europe and ultimately maybe to the other side of the Atlantic.
Excellent, thanks, Simon. It's such an important point that a future clean energy world means that everyone can contribute something, unlike the historic fossil fuel world where we have producers and consumers. Of course, as long as it's all interconnected. I haven't got much time left. Peter, in terms of a wish list from your side, if you had a magic wand, what would you do?
I can't say Ferrari.
You can.
Okay, that first.
I'm not sure it answers the question.
So I think the first one is probably regulation, but regulation in the right place. So what I mean by that is, take the UK pension market, TCFD reporting is now mandatory for all schemes over $1 billion. Why? They are already the schemes that are thinking about climate and nature. What about the thousands of schemes under that? So there's the right direction in terms of what the governments are trying to achieve, but perhaps in the wrong place. The way perhaps to think about it was, why don't you start from regulation on the schemes below $1 billion? That will then start to drive them saying, well, actually, this is really difficult. How do we think about this? It's quite expensive to do a TCFD report, and seek other ways to drive capital into a single larger pool, rather than starting with the guys who are probably already doing it. So regulation, but regulation in the right place. Second is probably data. So I think some of the challenges we get around, why don't you understand the risk of this, nature, climate? Fortunately, the data isn't there. So, we did a first TCFD report in 2021. 50% of our corporate bond portfolio was covered. We've just started to look at nature data. It's even lower. So we understand the issues around making nature positive investments and why it might be good, but also if the return isn't there, it has to do something else for your portfolio in terms of risk mitigants. And if you can't evidence that with data, it becomes very hard to make it a pure investment case for it. So data, improvements of data at a company level, which then feed through into data we can use to assess risk and return. And then probably just sort of a change in approach to asset allocation. So I was talking about, ultimately in the UK, DC is the future of savings. It's where the money's going. Where do we want to be in 5 to 10 years? Moving away from a fee-based view of the world to what is the expected return? What are you contributing with the capital that you're allocating? And how is that beneficial? But that is an engagement and education piece rather than forcing people down a route. I think we're starting to see it, but it's a slow burn, but it's about how you educate people on moving away from what is the cheapest and most liquid solution to what is the best solution.
Got it. Thank you. A move from cost to value, I think, is very important there. Richard, from your side?
I think policy clarity is sort of key in terms of mobilising capital now into the early stages of these projects. So visibility, roadmaps, national energy and climate plans that the governments are setting, which set out their decarbonisation targets and sort of how they're looking to get there in terms of level of wind, level of solar. The new Labour government in the UK has been quite bold in the targets it's set by, in terms of decarbonising the power system by 2030 and setting specific targets on offshore, onshore, wind and solar. So seeing more of that is helpful. I think really great to see, Nicholas called it a manifesto in terms of the Draghi report in Europe. So it's great to see that clean energy is deemed to be at the centre of competitiveness for Europe. But that's got to, there's got to be private sector capital to go into that. And at the moment, that's just quite difficult to do because there isn't a route in to, it's not for lack of project ideas, but there isn't a route to really bringing that private sector capital into the grid particularly and long duration storage in Europe. So bring in that regulation to incentivise the private sector capital in.
I think that's a really good way to then draw a line under things and kind of sum up what we're saying. I think the key messages coming out of this is the necessity to attract different types of capital for different stages of projects. Obviously, the need for a stable and consistent regulatory ecosystem, and to some extent, the bad stuff here is the good stuff. And what I mean by that is the adversity we've seen in the last few years in terms of bad geopolitical stuff happening, bad climate stuff happening, is forcing progress in this respect. And I think that's a really good point there, Richard, about the ecosystem, the climate policy big bang we've seen in the last few years in Europe. It is actually shining a light on these things, like the point you just made there about the fact that what we just talked about in terms of challenges of getting investments into the grid is critical, and there is so much private sector capital which could go into the grid, but it's very difficult because those grids are still owned effectively by governments and by countries, and there isn't a route for private sector capital. So hopefully that gives everyone a good perspective on some of the challenges of mobilising capital into these areas, and the kind of regulatory and policy tools in which might be used to push things forward. I'm going to hand over to Åsa now, who's going to moderate the next panel, where we're going to be talking about another challenge, which is that these areas we invest into or want to invest into, in particular energy and food, can be quite commodity-like in their nature, and that creates challenges itself. But I'd just like to say thank you, and could ask everyone to say thank you very much to our panellists. Thank you.